So this is going to be an application of the income statement, okay? And we call it an application of the income statement because you use the income statement to calculate EBITDA, and the acronym itself, doesn't really mean anything. And I think even people who are working there's some people definitely that work in the finance industry to this day that don't fully appreciate or understand what EBITDA really means. Okay, so hopefully I can give you a lot of insight on a high conceptual level again, using, I think, a decent analogy, and that'll help you understand it better because you grasp what it really means. So, EBITDA is another way of saying cash flow. Okay, and I'm just going to give you the raw definition right now. And later on at the end of the video, once you're done and you think you've had a eureka moment, you can come back to the beginning, rewatch this slide, and I think maybe hopefully you'll kind of be like, oh, that totally makes sense. So EBITDA, recall that we talked about earnings. So this is actually what it stands for, right? Earnings before interest, taxes, amortization, and depreciation. So we talked about earnings. That's the very bottom, what you're left with after you deduct all expenses from revenues. And then the word before. The word before just means that we're going to be adding everything uh, below this, okay? Because you have earnings that's at the very bottom, what you're left with. But if you want earnings before certain expense items, we have to add them back, right? So earnings before is referring to before you deducted. So interest, okay, taxes, amortization, and depreciation. It means you take the very bottom net income and you add back these four things, all of which can be found in the expense line items above the bottom line. Okay, so if you recall, and I don't have it drawn up here, but recall that revenue was at the very top, and in the middle you have a shit ton of expenses that have different line items, and at the very bottom you have net income or earnings. So I'll just call it net income at the bottom. Net income is earnings. So it means that you're taking this and you're adding four things in the middle, and that will give you EBITDA. Okay, so let's jump into the analogy. Hopefully, it really helps kind of simplify things in your mind, which for me, I find once I can conceptualize it, I can understand it better. So here I'm actually going to try to introduce two concepts, and they're really important when you're doing analysis in the commercial banking space or in other higher finance roles. So I find it always really relatable if we kind of address things from the individual level. Okay, so let's think about us. Okay, and on the left side here, this is where I'm looking at. So let's think about EBITDA kind of, let's just say we're going to call EBITDA for ourselves as just cash flow. Okay, because EBITDA is just an acronym, it doesn't mean anything. So we're just going to assume that EBITDA is cash flow, but we're going to think about it from our perspective. So once you get a paycheck, right? Once you get a paycheck, you have to deduct certain things that are necessary for you to live. For example, you got to pay for food, right? You got to pay for rent. You got to pay for insurance, and maybe you go to the golf every month or every week actually if you're spending $300. But so these are the four things that I chose that you'll have to spend, to keep yourself alive. And what you're left with after you deduct all these expenses is your cash flow. Okay, so when we think about EBITDA, what EBITDA is the amount of money that you have for that you can do whatever you want with it. That cash flow, or sometimes we call it free cash flow. It's free for you to spend on, let's say, at Sephora. You can buy anything you want with it, but most importantly for the bank, you can use that money to pay back a loan and the interest that you owe over time, right? every month, assuming that these expenses stay the same, you're always going to have $100 extra in your pocket. So if you want to borrow money and let's say you have to pay back $50 a month, then the bank is gonna, analyze your cash flow and say, yeah, we can lend you the money because you have $100 in cash flow to pay us back. Now, obviously, EBITDA, we added a few things back, and I think I'll explain that on the next slide, what those things are and why we add them back. But I want to introduce the idea of an adjusted EBITDA, adjusted cash flow. So why do we adjust? Like, what does that mean? So it sounds really complicated again, but it's a really, really simple concept. You're going to notice that the table on the right is actually almost identical to the table on the left, with the exception that the Gulf is gone. Now, I put that in there deliberately because Gulf, it might be an expense. It might be something that you do every month, but do you need it? Is it necessary for you to survive? No, like I think you'll live without spending $300 a month on Golf. So what happens is your adjusted cash flow, sometimes when we analyze it, sorry for the random scribble, but when you analyze a cash flow, you could recognize that, hey, like this person spends $300 on Golf. Maybe that was only for that month. That was a extraordinary or unusual expense that they incurred. So in reality, they have $400 of free cash flow or adjusted cash flow in a particular month. Okay, even though you see on their bill, they have $900 worth of expenses, you can adjust the cash flow. So what you're doing to adjust the cash flow, here I eliminated this, but let's say that, where's the eraser here? Let's say we didn't eliminate it, okay? So let's just erase all this. Let's say we didn't eliminate it to change it from the left side to the right side. If we started at the bottom and we recognize Golf is something that, is discretionary or not really something that's going to happen again and again, we could also just add it back. We add this expense back to the cash flow, 300 plus 100, and we get back to this adjusted cash flow number. And that is kind of like, hopefully you're having a mini breakthrough and you realize that that's really what EBITDA is doing. Okay, so let's wrap it up in the next slide. It's going to be a little bit fast, but hopefully it's simple enough that you can grasp it. Okay, so for the sake of continuity, I've preserved the same income statement as the one that I used in the income statement video, just so that you don't have to be looking at a brand new statement every single time. And we have the calculation on the right side here, so let's just go over it together. So this is only for 2025, by the way, and starting with earnings, recall that earnings is the same as net income at the very bottom. So we have 29,750. We're going to add back interest. And the reason why we add back interest, which is found in the operating expense area, we add back interest because we're trying to figure out a company's ability to kind of take on debt in general. So if they already have interest in their operating statement, it means that like that money is being used to pay debt obligations, right? But we're trying to measure like their total ability to pay debt obligations. So we want to give them that credit back. Like if they're already spending that amount, on debt, but we're trying to measure how much debt they can take overall, we have to first give that amount back to them. Hopefully that makes sense. If it doesn't, please follow up with me. I'll explain it in a different way so that it's more understandable. Then we add back taxes because taxes like comes after you pay all your expenses and your debt obligations, including interest, is part of your expenses, right? So even though there is a number here, let's say hypothetically, this company had more debt and they had to pay more interest, it will just reduce their earnings before taxes because like the government comes in at the very end, because realistically, really, we can say like a company's earnings is earnings before taxes. That's how much they actually made in the year. But like obviously the government's going to come in and with a microscope and say like, hey, like this portion of your earnings belong to us for taxes, right? If a company, like hypothetically, if they made $0, there actually isn't even an income tax expense because you don't get taxed if you don't make money. And that, what I just said there is actually like some companies can manipulate their operating expenses to pay less taxes. If you know where I'm going with that, that's a little like extra Easter egg there for you. Um, then we add back depreciation and amortization. So these two, a little bit intimidating because the word might not be familiar to some of you, but they really mean the same thing, right? But there's a slight nuance. So amortization usually refers to, like, let's say you buy like an equipment, like a tractor, a car. Obviously, over time, the usefulness of that car starts to decline. So amortization measures, like, let's say you buy like a new Porsche off the lot. Over 5 years, it's going to decline like, I don't know, like 20, $30,000 in value. That's amortization, although amortization more specifically refers to its useful life. But you can think about it in the same way. Depreciation is very similar, but you're going to find that you rarely see depreciation on a income statement, especially in Canada and for certain types of companies, because depreciation is really reserved for non-tangible assets. Like, let's say you have an IP, right? You have a copyright to something. It doesn't last forever. And as the copyright, let's say you paid like $1 million for the copyright to some music or some movie, right? To own it and license it out or whatever. Over time, like that's an accounting way to mark the devaluation of those intangible assets. The most important thing about these two is that, like, let's say go back to the Porsche example, right? You buy the Porsche for like, I don't know, like I think it's 60 grand for the Macan now, something like that. I'm not, rich, so I don't really haven't looked into the prices. But let's say you paid 60,000 for a Porsche, and then, like I said, over 5 years it declines $30,000 in value, but like you're not losing $30,000 cash because you already paid for the Porsche upfront in $60,000. So you're not like losing money monthly on that amortization. So the most important thing you want to know about these two items, that it's non-cash. So what that means is it's not a real cash expense. So it's like a fake expense. You're not paying any cash for it, so you add it back because we're talking about free cash flow. Remember, EBITDA is cash flow. This is not cash, so you're going to add it back. So anyways, that's a long-winded way of explaining both those two items and why we add them back. Like I said, you're never going to see depreciation. If you don't see any of these interest, depreciation, or amortization up here, and you're trying to calculate EBITDA, it just means that it's zero. You see that? I just put zero there. So then you add it all up and you get an EBITDA of $39,400. So to a bank, that's how much cash flow they have to service principal payments and interest payments. So when us, like assuming we're the bank, we're trying to make a loan, we're trying to offer a loan, in order to determine whether they can pay for, like, whether we're going to offer them 500,000 or a million, we're going to look at EBITDA and see how much EBITDA there is, and whether that amount is higher than the total principal and debt that they'd have to pay every month or every year. Okay, so usually and this is another just another Easter egg for the future. Usually a bank wants to be safe, so they're not going to say like, okay, you have $39,400 in EBITDA. They're not going to give you a loan that makes you pay $39,400 in like principal and interest payments. They will usually want your EBITDA to be like 1.2 times the amount of principal and interest that you have to pay. So they bake in a certain margin of safety, okay, and that's important to know for later. I wonder if I'm missing anything here. Oh yeah, right. So as an exercise, I would encourage you to pause the video for like few seconds or and try to calculate the EBITDA for 2024. Okay, so I'm gonna give you the 3, 2, 1, go, and then you calculate it, and I'll give you the right answer. And if I if I calculated it wrong, please call me out and report me. Okay, so 3, 2, 1. Okay, pause it. All right, so I'm going to assume that you paused it, okay? So the right answer for 2024 EBITDA is 23,075. Okay, so that's a little bit of practice for you. Um, and yeah, next week we're going to try to go into the balance sheet, and this should be everything that you really need to know for the income statement.